Good afternoon, very warm welcome to all of you. We have two of the industry bigwigs with us today to help us in terms of how to decipher budget. Is it very different from what we had seen on-account budget? So let me just introduce the eminent panel of speakers. We have Mr. Bharat Pareek. Bharat, if you can raise your hand. So Bharat had our products, somebody with 20 years of experience in financial markets, and he was heading one of the biggest treasuries, which is Reliance Treasury. Then we have Mohit. Mohit is basically zonal head for North. We have Sanjeev who dons our business in South and East. And my name is Manish Malhotra. I take care of West Zone for ISEC. So Bharat, over to you to take it forward.
Thanks, Manish, and welcome everyone. We have two eminent speakers today. We have Nilesh Bhai, who need no introduction, and he has been veteran. He has been guide, force, whatever you call it, for a lot of us who have grown under his guidance for last 20 years. And we have Pankaj Pandey, who is our head of research, and which has an amazing track record in terms of his ability to pick up the stocks and the trends, and which has been reflected through the success of our research at ICICI Direct. So welcome both of you. To start with, Nilesh Bhai, just wanted to understand, we have seen, continuation of policy. We have seen a very sharp, a continuous process of reduction in terms of the fiscal deficit to 4.9, and broadly taking, all those things which we were thinking for last 10 years, whether there will be continuity or not with the change in the government. But I think there are a lot of continuity what we can see. But your take to start with, Nilesh Bhai, on the budget and your overall assessment.
So, Bharat Bhai, the budget has come well ahead of everyone's expectation on fiscal consolidation. Last year, the budgeted fiscal deficit was 5.9%. Today, we are talking about 4.9%. 1% reduction in fiscal deficit, very few countries have done. And hence, it's a commendable thing. What is more commendable is that even this number looks overstated because revenues are estimated very, very conservatively. The RBI dividend itself is about 2 lakh crore plus, but the total dividend income expected is 2.5 lakh crore. So there will be overstatement there. The advanced tax collections are up about 25%, but the corporate tax collection and personal income tax collection is much less in the budget. Divestment number is 30,000 crore. वो तो एक PSU divest करके मिल जाएगा. So revenues are estimated conservatively, and hence this number looks far more reliable. What is more important is that next year का 4.5% already बोल दिया है. And on top of it, we are committed to bring down our debt to GDP ratio thereafter. I won't be surprised if India becomes one primary surplus country from a deficit point of view. Fiscal deficit minus interest burden will become positive. Second, my feeling is that India's rating will get upgraded if we bring down combined fiscal deficit of center and state to below 7%. It has come below 8% for the first time. And finally, as your rating rates gets upgraded, your cost of capital comes down, which will be beneficial for stock market. So valuation of stock market will get boosted by this kind of budget, which is fiscally prudent.
Sir, your take on the other part of the economy in terms of we understand this part, but from the growth point of view, industry point of view, and especially I think this entire focus towards skill development and how this is going to change the narrative for next few years. Considering that I think first time we have seen minister talking about and starting with the skill development and human capital, which is the largest capital we have as a country. Because that's a two place where we really go and strike against the rest of the world, which is either our exports, which is software driven export, which is again human capital driven, and the fact is that we have the largest remittance in the world, which is basically ultimately human capital driven. So what's your take on that, and how credible is that step, and is that step enough for us to really take this through, considering the demographic dividend which we have in front of us?
So Bharat Bhai, this is like five blind men trying to identify elephant. The problem is multi-dimensional, and hence any analysis will always fall short of the complexity. One thing we are seeing on one side, L&T saying that I have 45,000 white-collar worker requirement and I'm not getting people. On the other side, you hear headline that there is a job opening for 500 police or government employees and 5 lakh people rushed there. Why is there such a stark contrast? Are people only wanting government jobs where there is permanency of job, where there is higher compensation and lesser workload, versus working in back breaking kind of jobs, manual work? The second challenge for us is the all of us witness shortage of carpenter, plumber, washerman, laundry wala, maid, driver at our home. Is this just the aspirational difference, or is this something else? Third, in our business, I'm always short of compliance officer. I try to recruit people and then they run away, and then I'm again back to recruitment. In my digital side, I'm always short of people. I try to recruit people, people run away, then I try to again go back to recruitment. So there is challenge of job as well as challenge of skill. Now, in this budget, we have focused on skill. But it's not only push, there's also a pull. For example, in China, it's a vast country compared to India, but they have lesser number of schools than India. Why will a country which is so big than India have lesser number of schools? Because they took a call that let children walk 10, 12 kilometers, but we will build big schools where there will be computers, there will be playground, there will be toilets, there will be teachers, and so on and so forth. So they focused on quality rather than quantity. We took a call that bachcha sirf 1 kilometer chalna chahiye, so we will set up schools everywhere. We focused on quantity rather than quality. So some schools don't have toilets, some schools don't have teachers, some schools don't have playground, but technically there is a school. Now, you know the output. चाइना में बच्चे निकलते हैं वो एक क्वालिटी के निकलते हैं, हमारे स्कूल्स में जो बच्चे निकलते हैं वो दूसरी क्वालिटी के निकलते हैं. So there are far more complexities and one budget will be in no position to solve it. What we believe, one, in agriculture sector, 10 to 15 crore Indians are additionally employed. If we remove them from agriculture and put it into industry and services, agriculture output will not get impacted, but economic growth will take off. Second, in many parts of India, women don't work outside of home or outside of their own field. And that's why their participation in labor force remains low. And hence, we need to increase women's participation. Third, education is different. Knowledge is different. People are interested in blue collar work, not white collar work because of harsh challenges. And we are not equipped enough in terms of skills to do lots of work. All these problems needs to be sorted out. In this budget, there is focus on skilling. Execution will be key. In this budget, there are incentives for recruiting people, but people will recruit only when they see the demand, when they see the opportunity. Can one budget solve this problem of employment? Answer is undoubtedly no. We will have to continuously take many steps and focus on execution to do these things. Two examples I'll give, Bharat Bhai. In Kendrapada, Odisha, we set up a plumbing institute for providing skills on plumbing. Today, that institute is producing plumbers not only for India, but also for abroad. Second, in Northeast, we have set up Japanese Culture and Orientation Institute. About 1,000 Northeasterns, after learning from there, has gone on white-collar job in Japan, providing elderly care services. Maharashtra recently did a tie-up with Germany, where 10,000 Maharashtrians will be trained for job requirements in Germany on a work permit visa, not citizenship, but work permit visa. These are some of the examples which we'll have to magnify, multiply on a much, much larger scale. Today, $125 billion remittance comes from abroad. In the Middle East, in the US, you find many Indians working. We need to improve it significantly higher so that $250 billion remittance comes. We have surplus labor, world has surplus capital. In free trade agreements, let's negotiate that we open our market for their capital and they open their country for our labor.
Great, sir. I think it's a long journey for us. I think we have just started. It's a first step towards making it possible, and I think we will make it possible. Before I get into more detail, I think one important thing which was basically touched upon in this time, they've committed that they will do a comprehensive review in next 6 months, and we will wait for those details. But there are significant changes in direct taxes. Your take on those, and specifically the impact of that on the multiple asset class.
So, Bharat bhai, एक कहावत है, the last straw on the back of camel. We must remember that proverb. The camel in this proverb is the capital market. First, camel was told that only STT is being levied in lieu of capital gains. Camel said, fine, no problem. Then in 2018, we told the camel that while STT is there, we have to levy a little bit of STCG at 15% and LTCG at 10%. Camel said, no problem. In 2024, we told the camel that I'm increasing STT, I'm increasing LTCG from 10 to 12.5, and I'm increasing STCG from 15 to 20. At least on the budget, then now camel is still fine. But please don't put that last straw on the back of the camel that the back breaks down. ऊंट की पीठ पे तिनका मत डालिए अब. Now, whether it's 12.5, 15, 20, I don't know what that number is, but always remember the proverb, don't put more burden on capital market than necessary. If you take that out, I think market has behaved very nicely with the imposition or increase in capital gains tax. It has also taken on stride real estate, where if your returns are higher, this is beneficial, but if your returns are lower, new change without indexation is not that beneficial. In debt mutual fund on March 23, you said there will be grandfathering. In July 24, you are saying that there's no grandfathering. These changes are not going to give you tons of money, but it does, create a little bit of anxiety among investors about stability of policies. So we need to simplify taxation policies undoubtedly. And when we simplify, there are some losers and some winners. But I think eventually stability of policy is also very, very important. And we should focus as much on simplification as on stability. Today, thanks to the current budget provisions, investment in government securities will have TDS. Investment in real estate will be without indexation, albeit at a lower long-term capital gain tax rate. Investment in equity fund of fund, gold fund of fund will have concessional tax rates. Investment in debt funds loses grandfathering. Investments in equity will now have higher STT, higher STCG, higher LTCG. In terms of your asset allocation, we think one asset class which stands out is gold. There is 9% duty reduction in import duty from 15 to 6. Assuming there's no revision in the GST, then this is good price to invest into. We are bullish gold from a dollar point of view. And with import duty reduction happening, hopefully now this 6% import duty will remain for some time. And hence, gold is one asset class which can be owned post this budget.
Thank you, Nilesh bhai. And just to bring in Pankaj, Pankaj, you heard Nilesh bhai on his variety of topics. What's your take from a market specific or a sector specific which you believe, and then we can open it for Q&A. You're on mute, Pankaj. You need to.
Okay, you have to unmute.
Yes,
Yeah, hi,
Pankaj.
good morning, Bharat. I think, overall, when you sort of look at structurally why the markets have been liked for one, I think the focus on infrastructure creation continues. So there is no sort of a letdown there. On the fiscal deficit side, also, things are moving in a right direction. And I think whatever is disappointment largely coming is from the higher short-term and long-term gains. But our sense is that while this is a sort of a near-term negative, but it's definitely not a showstopper for our overall direction of the markets. Because what you're still trying to do is that you're trying to sort of solve the structural problems of the economy. And over a period of time, we've seen that be it sectors or be it all the when you sort of look at taxation or in terms of capex or in terms of the job creation, I think most of the things are largely being driven in the right direction. Like Nilesh sir highlighted, yes, you have this volatility in policy, which is definitely not a welcome move. But I think when we are sort of looking at markets, one I think perspective is that whether it is political stability or whether it is economic stability, we are doing quite good. I think valuation is on a richer side, and on top of it, if you sort of do something of this sort, wherein the short term or the long term capital gains tax goes up, that increases volatility in the market or volatility of returns, and which is not a very welcome step to sort of say that. But our overall sense is, like I said, it's not going to be a showstopper. From a positioning perspective, I think what we are expecting is that all your traditional beneficiaries of capex, the core sectors like say cement and steel, steel obviously needs some kind of a protection. I mean, when you look at the results of the some of the big companies, I think the prices are quite subdued because Chinese players are operating at a very thin margin. And cement also, if you look at, you are seeing a fair amount of consolidation happening. About I think top five players now contribute about 60% of the capacity. Then the capital goods and the infra as a space is also sort of there. And then when you're talking of energy security, then I think power is the one sector which comes up where the runway for growth looks pretty good. So from that perspective, that is one. And then you have structural beneficiaries like, say, real estate or banking, because banking overall, our sense is that probably we are not going to see the kind of volatility earnings, be it PSU banks or private banks, the way it used to happen earlier, because RBI has been largely quite proactive in terms of taking the steps. And I think auto is another sector which is witnessing a transition, and I think it is a good sector to sort of play the premiumization wave. We have already seen 50% kind of a jump in the average selling prices or the purchase ticket sizes for most of the segments, be it two-wheelers or be it four-wheelers. So in general, things are largely, or the bullish bias largely remains intact. Valuation is a bit of a challenge because, I mean, you're trading at somewhere about 20 times on a, 21 times on a forward basis. And our sense is that with the kind of run up we have already seen in the market, probably some consolidation ahead is very much possible. But structural bullish bias largely remains intact.
Thanks, Pankaj, and I'll just invite the other panel guys. If you have any specific questions for Pankaj and Nilesh, please go for it, and then I will take questions from the chats and the multiple media channels where we are live, and we can see some questions there. So I'll take those up. Maybe Sanjeev, Mohit, Manish, if you have any questions, please go for it.
Thank you, Bharat. Thank you, Pankaj. Nilesh bhai, always a pleasure to listen to you. Nilesh bhai, my question is, the budget has proposed setting up of digital public infrastructure for coverage of farmers and their lands in the next 3 years. So my question here is that what, according to you, you see as the potential broader outcome of setting up the DPI on the agricultural sector and the digital economy?
So, Sanjeev bhai, when I was a kid, I had read about a Latin American country where giving title, land title to farmers changed their economic history. Now, I'm not exactly able to remember whether it was Peru or Chile or maybe some other country. But one thing, which stayed with me all throughout years is that if you have appropriate title to a security that is pledgeable, it gives you access to organized financing. At the time of independence, maybe 90% of agriculture financing was with money lenders, and hence we saw Kanhaiya Lal in Mother India. Now, 23% of financing is still with money lenders. If we can bring that down to zero, everyone benefits other than money lender. Cost of borrowing will come down. Availability to organized financing will increase the coverage, and they'll be able to come out of poverty much, much faster. Land title in India is amazingly complex. There are few states where it has been digitized and it has produced brilliant results. Aadhaar eliminated so many of the fake recipients. I think digitization of land record will have multiple purpose. One, remove the fake agriculturist and ensure that the black money becoming white through agriculture comes down. Second, give access to farmers to monetize their land by pledging their land title so that their cost of borrowing can come down and their access to organized financing goes up. Third, I can probably rationalize subsidy. Today, it's quite possible that on a 5 acre of land, you are taking 50 acre worth of subsidy in fertilizer and water and so on and so forth. Fifth, tomorrow, it might be possible. And this idea someone gave me on education side. We have many schools where teachers don't come on time. They don't provide appropriate teaching. In Uttar Pradesh, we have seen how teachers protested when they were told to have digital attendance so that one can check whether they are attending the school or not. Now, how do you reverse this? Give education coupon to citizens and allow them to spend that coupon in whichever school they like. I may send my kid to 1 kilometer away school. I may send them to 10 kilometer away school if I believe 10 kilometer away school is better. Straightway, the 1 kilometer away school will have to improve its performance. Otherwise, they won't attract students. Today, it doesn't matter what education you give. If teachers don't come to school, it's fine. Tomorrow, that will not be the case. And straightway, there is pressure on schools to deliver and it improves quality. Can we do the same thing in agriculture, where we can provide direct benefit to the needy farmers and remove the intermediaries who are today siphoning of subsidies? These are all, wish list. I just hope and pray once we have the highway, we will be able to build upon that. And digitization of public infrastructure, digitization of land record will be step in those directions. Will this be a smooth journey? Answer is no. We have seen how teachers came together and protested, and finally, vote bank politics pushed government on that reform. We have seen that in farm reforms also earlier. So, as a citizen, we'll have to also support government to ensure that they can carry out this kind of reforms. There will be vested interest who will jump immediately once they realize that this digitization is going to take away their freebies.
Thank you.
Thank you, Sanjay. Thank you, Nilesh bhai. Uh, uh, I'll take one few questions, Nilesh bhai. And you are a part of a Prime Minister's advisory committee, and you have an access to all that persons who really matters. And I think one of the suggestion which is there on the board, which I'll just read, is that can we abolish CSR, create a CSR venture capital bank with equity given as a contribution, and then equity capital will not be a problem because of the perpetual funding. So I think what he is suggesting is that rather than doing this CSR, do 10% contribution to this. Better let that go at one place, and all those activities get consolidated at one place. So maybe a more directed capital flow of CSR to the activities which is skill development, education, and all those things can go. So I think that is a one suggestion which I thought I'd read it
Yes, very
for you.
good suggestion.
Sir, there are. I'll just take another question, which it says that sir, there's a proposal on buyback to be taxed in the hands of the recipient. Now, large IT companies are the one of the largest buyback. Do you think that this will change the way they remunerate their shareholders, or do you believe that will move away from just doing a tender offer to a screen base where there's no tax on either way, because you don't know the recipient, so you can't charge it. They will not pay the tax because they don't need to pay. And I think it's just a methodology will change, and effectively it's take away that pain of a what we call a dividend or a buyback tax.
So one, this will be only applicable when promoters don't want to tender. In that particular IT company, promoters also tender, and hence their buyback will be tender form. But the promoter company does not pay the tax, they are tax exempt. So the shareholders who tender shares will still have to pay the buyback tax. But rest of the companies where promoters are not interested in tendering their shares, they are all going to go to the market route, and you will end up paying 12.5% long-term capital gain or 20% short-term capital gain rather than applicable slab rates on your buyback tender.
So life is much easier. There's such a good market. You want to divest 2%, go and do a block deal of 2%. Balance, you do a buyback. End of the story. There's nothing much you need to worry about rather than having the
Absolutely.
taxation. So yeah. Uh, uh, just hold on, sir. I'll just take one more question, and I let me see. Sir, my understanding is that long-term capital gain on listed debentures were earlier taxed at 10% without indexation under Section 112. Now they will be taxed at 12.5% without indexation. But the budget document talks about taxation having brought down from 20% to 12.5% in case of long-term capital gain on listed debentures. Which version is correct in the sense whether we are better off or worse off?
The first version seems to be correct. I'm not an expert on tax, but the first version seems to be correct because there was tax of 10% on long-term capital gain on listed debentures beyond 1 year.
Great, sir.
So,
I'm
Bharat, I
getting.
had two questions.
Yeah, Manish, go ahead, please.
So, Nilesh bhai, you have been also expert on that side, right? So, what is your view on interest rate? Especially, everybody has been anticipating that US will cut now, and Bloomberg was talking about two cuts now, one cut. And how will and when India or ma'am will press the trigger, or will reciprocate, or RBI will reciprocate? So, what's your general view in terms of global scenario and Indian scenario?
So Manish bhai, Fed is deferring their rate cut because they're not getting data which can support rate cut. The labor market has been unusually strong. Unemployment levels have remained record low. Growth has been fairly sustainable, and inflation is not falling as much as they would have loved. And hence, they keep on deferring the rate cuts. And the market believes that aaj nahi to kal Fed will have to cut the rates. That has ensured that even though Fed is not cutting rates, US interest rates have been on a downward trajectory. We believe now market is pricing in September rate cut and thereafter more rate cuts. RBI is calmly watching the situation. Growth is higher than normal. Inflation is in the upper ranges of their target range, and hence they would like to bring it down. Everything else from rupee to financial sector stability to NPA, everything is under control. So why should they change anything when going is so good? Why repair something which ain't broken? So they are waiting and watching. The market is also comfortable that once Fed cuts, RBI will cut. And in the meantime, lower fiscal deficit means lower government borrowing program. This year, net borrowing program is lower than last year's net borrowing program. On top of it, there is debt FPIs coming to buy. So there's no price for guessing that over next 12, 18 months, interest rates will continue to go down. What was earlier 7% big figure has now become 6% big figure. But yields are 695, 699, 697, 7. I think over next 18 months, there is a very good chance that they'll go 50 to 75 basis point below from current levels.
Sure. Thanks. Bharat, back to you.
Yeah, thanks, Manish. Sir, there is a,
Well,
I think,
if I could ask one more question, both to
yeah,
Nilesh
yeah,
Bhai.
Sanjeev, go ahead, please. Yeah.
So, Nilesh Bhai, I think the budget has introduced a scheme of providing internship opportunities to 1 crore candidates in the top 500 companies. What do you think will be the impact on the top 500 companies on this?
So Sanjeev bhai, today, are those top 500 companies employing 1 crore employees? Answer is no.
No.
So it's a turnover and not necessarily recruitment. It's like Agniveer in private sector rather than full-time employment. Number two, a person trained in L&T or Tata Motors will become more employable? Answer is undoubtedly yes. They learn something and hence they'll become more employable. The third thing is that all these companies will also take apprenticeship only when they believe there is demand and they need to set up capacities or they need to recruit people. So it's a step in the right direction, but execution is key. It's not about 1 crore jobs. It's about 1 crore people getting trained over next 3, 4, 5 years so that they become more employable in other parts of the economy.
Thank you.
Thank you, Nilesh bhai. Nilesh bhai, there are. I just wanted to repeat, guys. Unfortunately, Nilesh will not be able to take any call when it comes to specific stock. This one
Pankaj
he
Bhai
can
is
broadly.
there.
Yeah, Pankaj bhai is that. So I understand your busy schedule, and I'll try to cover your question first, and then
Yeah,
I'll go to stock specific call with Pankaj, and that's the whole idea. To
yeah.
have both of you. So I'm not taking the questions which are directed on stocks, and I'll just focus on the sectors. Sir, I think there are questions which are basically talking about there's no incentive for a poor middle class. I'm using the poor for a middle class because they are the one who are always get rogered on both the sides, and they've been again ignored in this particular election. Sorry, in this budget. Plus, for the senior, there was nothing on those sides. Any take on that, or that is the story which will continue? Being honest taxpayer.
So, Bharat Bhai, if you are salaried employee, there is increase in standard deduction. There's also increase in NPS. I'm surprised that so many people don't know about NPS. And when I talk about NPS, they said, "अरे नीलेश भाई, आपका म्यूचुअल फंड इतना अच्छा कर रहा है, NPS में क्यों डाले?" Now, please compare NPS with your provident fund. Please compare your NPS with PPF. Compared to them, hasn't NPS delivered better return? Now the limit has gone from 10 to 14%, albeit for new tax regime, albeit with 7.5 lakh rupee limit on contribution. But Bharat Bhai, at 39% tax slab, even if I contribute 7.5 lakh rupee, 5% return is given from the tax exemption itself. Plus, on that, whatever return comes, 66% is tax exempt. So effectively, whatever I'm earning in my PPF, almost similar return, or whatever I'm earning in my provident fund account, almost similar return is already guaranteed in the NPS before meter starts. And then NPS manager जो return बना के देगा वो अलग. How many people are taking advantage of that? So yes, middle class can argue that the exemption limit has not gone up. But please remember that compared to average national income, the exemption limit is one of the highest in India compared to any other parts of the world. Now, one can argue that, oh, I am paying this much tax, but what do I get in return? Well, personal income tax is about 3.6% of GDP. Infrastructure investment is 3.4% of GDP. Now, one will again argue that, but वो तो potholed वाले roads हैं. भाई potholed वाले roads है सही बात है, but कितने potholed वाले roads हैं? Are there no roads? Are there no airports? Are there not power? Are there no ports? So there is no end to this, Bharat bhai, in terms of debate. But I think the budget has done a balancing job. They could have done something better, undoubtedly. But what they have done in terms of standard deduction, in terms of NPS and in terms of infrastructure investment, that is good enough.
Thank you, Nilesh bhai. We took a lot of time of yours, and thank you for your time, and really appreciate. And it
Thank
was
you.
wonderful budget, and I think we'll look forward for this continuity and India moving from developing country to a developed country much before what Modi ji think of. Thank you.
Thank you.
Yeah, thank you. So over to you, Pankaj. Now, I think there are a lot of questions on stocks, specifically to sectors and all. So the first question, which is there on the chat, is on fishery. I think there are a lot of incentive for fishery. So any take, any stocks, or what's really your take on that particular sector? It's an odd question, but yes, shrimp and all. There are some lot of aquaculture is what they are
Correct.
saying.
So, Bharat, we don't have a coverage, not tracking that space. I wouldn't want to sort of comment there.
Okay, fair enough. Any particular sectors or stocks, Pankaj, which you believe will be a clear-cut winner or a loser in this particular budget, or it's a more generalized one? But if you find any winner or a loser in this particular budget.
I think, Bharat, largely when you sort of look at from an interim budget comparison perspective, there's not much of a change or allocation change in terms of broader themes. What you look at, so our sectoral biases are not going to sort of change much. So we have been sort of like I highlighted, looking at capex beneficiaries, so be it core sectors like cement, steel, or something like infra. Now in infra, yes, so what you see yesterday and today, players focus especially on Andhra are sort of getting a lot more attention. But generally, my sense is that overall, it is the same template which is going to sort of get preferred. Probably, I think road is one segment where we haven't seen much of a awarding or tendering. I think, and with the allocation being kept similar, because understand this last 4 5 months, we have not seen much of a capex related announcements. And so, if you are keeping the overall allocation similar, that means that in the next few months, you are going to possibly see a lot more announcements. Otherwise, just by sheer number of months, you can sort of reduce, or the allocation towards some of the pockets could have been lower. So in a way, I would want to believe that next few months of going forward, you are going to see a lot more announcements. So road is one segment where I think probably the run up has not been that great compared to when you look at say railways or when you look at some of the other pockets. So road-based players look attractive particularly, and obviously the infra ones also. So be it the likes of L&T or NCC.
Any view on IT, defense, renewable, railway? I think you covered, but defense and IT, I think, and railway.
So IT, if you look at overall commentary is still not great. What is good is that the worst is behind us. But the pace of improvement is still sort of debatable, not expected in 2025, possibly, probably not expected this year, but possibly FY25, sorry, FY26. But is that if even if the growth normalizes to say $6 to $7 kind of a number, annual growth number, 6 to 7% dollar revenue growth, I don't think IT is going to do something magical in terms of outperforming Nifty. So I would want to believe that it is going to structurally underperform unless something magical happens from the AI front. And I think the we still have a lot more water to sort of flow for AI to become more concrete in terms of outlook. Now, when you look at some of the sectors which have done very well, say the likes of defense. Now, in defense, the allocation has largely been same. We have seen 9% kind of a YY growth, and most of the stocks have done very well. Take any stock, it's available in excess of 45 times on a forward basis. So definitely not cheap. Expectation is that it should witness some bit of a price or a time correction, largely because of the sheer valuations being on a higher side. But to say that defense story ends here or we are not going to see further improvement, I think defense is changing a lot for sure. And with hostile neighbors like say China and Pakistan. So, for example, we are still struggling with a 4.5 generation aircraft, whereas the neighbors have already deployed the fifth generation. So defense will have a long runway for growth, and any kind of a good correction or good consolidation is the time when we should look at having new exposure towards defense stock. Now, some of the other categories, like say, for example, power, I already highlighted that power is one story which is looking like is going to be there for the next 10-20 years. Because see, understand this, the BJP Sankalp Patra talks about energy independence by 2047. We spend about 10 lakh crores in terms of net crude oil bill in terms of overall importing crude, which is a massive amount. We are spending 11 lakh crores on the overall capex, which is what the center budget is. So, for energy security, what is required is massive amount of capex, especially on the renewable energy side. It could be solar, it could be wind, and it could be even the budget mentioned about small modular reactors. So from that perspective, the entire power as a space or the value chain looks very attractive. What we understand is that when you speak to companies, next 2-3 years there is hardly any supply available for transformers, and even the M&A is not available. And it's not that in India this is a challenge. This is becoming of a global challenge because the entire world is shifting towards more on the renewable energy side. So obviously there is a shortage of capacities of transformers, just to highlight, and which is why this is one theme which is going to be there for a longer period of time. And I think budget that way is really not or is directionally focused or biased on that direction. So from that perspective, I think power looks extremely attractive.
Any specific name or a themes transformer you spoke, or do you have any coverage or any of the companies which you want to talk, or will let prefer to be on a sector specific? Then we can move to the next one.
So what we intend to do, Bharat, is that we might come up with some new baskets where we will have stocks which will where we are looking to have exposure of that kind. But see, power, you have traditional players like say NTPC, or you could have bigger ones like say, for example, Reliance Industries. So Reliance is putting up one of the largest capacities on the renewable energy side. Obviously, that is going to be channelized for producing hydrogen, but hydrogen, our sense is that India enjoys distinct advantage compared to global peers. And next 1 or 1.5 years, we'll start seeing further action on this.
Thanks. Any view on this NMDC due to change in the, I think some custom duty changes, or do we have a NMDC?
So one is NMDC next for 5 years is looking to double their iron ore production, and mind you, even the overall steel production is expected to inch up or almost double to 300 million tons. So NMDC core business is largely absolutely fine. I think our sense is that when you look at these traditional miners, the government is looking furthermore value from them rather than sort of being a pure miner of say coal, which is Coal India or iron ore. So if they are diversifying into newer areas, I think they will have a lot more role to play and they will become a lot more relevant in future. And both these stocks we've been liking very well from a portfolio perspective. So NMDC also is on the similar league, and we feel that both these stocks are looking good and will have their own set of opportunities which will sort of be thrown at them.
So, Pankaj will not take much of your time. We already maybe another 5-7 minutes more. So there is a simple question mark only. You can so can we assume market will correct down by 5-10% over a period of some short period, or it's more going to be a consolidation phase?
So I've been highlighting this that every year you could get a 10-12% kind of a correction in Nifty, 15-20% mid caps, bit higher in small caps. But when you sort of look at it from a budget perspective, structurally or directionally, it is moving in the right direction. And this short-term capital gains or long-term capital gain is really not a showstopper. So since we have, I think if you look at from the overall election outcome perspective, from the election days low, we have seen about 13-14% kind of improvement in or jump in Nifty. The small cap has gone up by 28%, mid cap by 23 odd percent. So it is fair to expect some bit of a profit taking to sort of happen or consolidation to happen. But I think whenever you get steeper cuts, one can sort of look to increase exposure according to the risk profile in either of the caps. So consolidation can happen, but directionally we don't see a big or a steeper correction in the market as of now.
You have any view on BHEL?
So BHEL, when you sort of look at BHEL is also sort of diversifying their business model. So which is what has been the case with most of the PSUs. So BHEL used to be a traditional boiler supplier, but now when you sort of look at, they are going to have a lot more new segments which are they are going to sort of tap. Similarly, Coal India, pure coal-based player, whether you look at even the upstream companies like ONGC, Oil India, or downstream companies like IOC, all of them are diversifying their business models, and all of them have been trading in the range of say P multiple of 5-6 times. But if you're changing your business model towards more on the renewable energy side or catering to the value chain of that side, I think most of the companies will have a lot more better days ahead. So don't really sort of exit just because there has been a sort of a run up. I think it is better to sort of allow. It is better to allow the stock to sort of consolidate rather than sort of exiting and trying to sort of time it. So BHEL included most of the PSUs. I think whoever is changing their business model for better should be held on to.
Last question, Pankaj, from our side on the NBFC. I think there are two names specifically, but yeah, Bajaj Finance and Poonawalla. In generally, your view on the non-banking business on the NBFC side and these two names in case you have a view.
So Bajaj Finance still trades at 5-time book, relatively expensive, although the growth rate of 30% plus AUM is still maintained. But Bajaj Finance got 5 multiple largely because you have hardly had retail NBFCs. Now you have a lot of NBFCs which are there. So, for example, some time back we had buy on L&T Finance, or we've been liking Shriram Finance, which was a CV player looking to sort of diversify into other segments. Specialized NBFCs also we are liking. So IREDA, we had come out with a buy rating earlier. It's part of some of our portfolios. Since the stock had run up, it had witnessed a bit of a correction, and we have again released a report. So I would want to believe that a company like IRDA can continue to deliver 30% CAGR kind of a AUM growth, largely because banks cannot really fill in that space because banks have sectoral limits to sort of meet. Specialized NBFCs or NBFCs which are changing their business model from wholesale funded to retail will do well. Bajaj Finance, I would expect them to underperform.
Great. Thank you, Pankaj. I think there was one question on LTCG and STCG. Do you see any material impact of these two, or just that we have to pay just a little bit more higher tax? And I think that's a broad story.
So one is, yes, it pinches to a lot of people, but from a government perspective, it's a very small portion of people which are getting impacted. Not the quantum wise, because quantum is quite significant. And I think what are the kind of sense what we're picking is that this is the destination and not the journey. So from that perspective, probably these numbers, or 12.5% on short term and 12.5% on long term and 20% in short term is going to stay, and possibly is not going to sort of see further hikes. A bit negative, bit dampener, but I think market is going to take that into stride, because I think market will focus more on structural positives than near-term dampeners. So, which
Thank
is
you.
why I said it's not a showstopper.
Thank you, Pankaj. Thank you, everyone, and thank you for joining us. I'm sure we were able to bring in a little bit more clarity over what's really happened in the budget and the way forwards. And looking forward to be connected with all of you again. Thank you, everyone.
Thank you.
Thank you.
Thank you, Pankaj.
Thank you.
Thanks.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.